Welcome to Breaking News to Trading Moves. I'm your host, and today we're looking at a story that acts as a bit of a reality check for the energy sector. Usually the conversation in this space is entirely about demand, how much power data centers need or how many people are clamoring for green energy. But the news we're breaking down today reminds us that demand just isn't the only variable that matters.
Right. Exactly.
Yeah.
Usually we talk about efficiency gains or just the raw gigawatts required, but the news item we're looking at today highlights a totally different force, which is friction. Specifically, and this is key permitting, policy, and logistical friction.
Yeah, we're talking about First Solar, that's ticker FSLR. They recently provided some guidance that the market clearly did not like. But what stood out to me was that this wasn't really a demand problem. It wasn't that customers suddenly stopped wanting the product.
No, not at all.
It was entirely about whether the companies can actually get the projects built on the timeline Wall Street has modeled.
Yeah, we're looking at First Solar's outlook for 2026. And the reason we are spending time on this is to identify the specific winners and losers that emerge when project timelines start to slide. Because, think about it. When a billion-dollar project gets delayed, that capital doesn't just evaporate.
Right.
It moves. It looks for a home somewhere else in the value chain.
So let's get the headline numbers out of the way first. First, Solar, FSLR, issued guidance for their 2026 net sales. They are projecting a range of $4.9 billion to $5.2 billion.
Right. And to put that in context, that range came in below what the street was looking for. Naturally, the stock price reacted poorly to that. But the raw number is less critical than the actual reason behind it.
The why is always the driver for us here. The company cited project permitting delays affecting their customers. It's essentially a bottleneck issue, right? The customers, the developers building these massive solar farms just can't take delivery of the panels because they can't get the permits to break ground or connect to the grid.
They also mentioned a projected tariff hit for 2026, which plays a role. But that point about permitting is what creates this concept of timeline shock.
Timeline shock.
Yeah, timeline shock. When you have delays in permitting, or specifically in interconnection, which is just the technical term, for getting permission to physically plug a new power plant into the wider grid, those utility-scale projects basically slide right.
Slide right, meaning they get pushed further out into the calendar year, or even into the next year.
Exactly. And in this industry, a slide isn't just a calendar update, it's a major financial event.
Because when the project slides right, everything else has to move with it. The orders for the panels, the delivery trucks, the payment schedules, all of it.
Precisely. And that has a direct impact on a manufacturer like First Solar. Even if the long-term demand for solar is fully intact, which it seems to be, the near-term trading battleground entirely changes. It becomes all about revenue recognition and factory utilization.
Let's pause on factory utilization for a second. I want to make sure we're really clear on why that hurts the bottom line so much.
Sure. Think of a massive factory, like a giant furnace. It costs a fortune just to keep it running. You've got lights, labor, maintenance, all of that has to be paid regardless of how many solar panels you actually push out the door.
Right, the fixed costs.
Exactly. So if a customer calls up and says, hey, my permit is stuck in red tape, don't ship those panels yet, the factory output slows down, but your fixed costs stay exactly the same.
So your costs are being spread over far fewer units.
Correct. That's operating leverage working against you. When volume drops, your profit margin on every single unit you do manage to sell just collapses because the overhead eats it up. That is the mechanical reason why the stock drops so hard on a volume delay.
Okay, so that's the setup. We've got timeline shock triggered by logistical friction. Let's break down who takes the hit here. We should probably start with the obvious losers in this scenario, which is the solar complex itself.
Yeah, it starts directly with the utility-scale manufacturers and the hardware companies tied to that project timing.
We mentioned First Solar, FSLR, as the primary example, but who else falls into this specific bucket?
You really have to look at companies like RA Technologies, ticker ARRY. They make the trackers.
The motorized mounts that move the panels to follow the sun.
Right. And the logic is identical to First Solar. If a developer pushes a project out because they can't get a permit, they don't need those trackers sitting out in the mud for 6 months. So shipment schedules slip.
And I noticed that alongside the guidance reset, there was discussion about margin pressure for them as well.
Yes, the reporting definitely flagged that dynamic. If Array's factories aren't running at optimal capacity, their margins compress too. That is the fundamental headwind for this entire group. If the dirt isn't moving on site, The hardware isn't shipping from the factory.
Okay, so that covers the heavy hardware. What about the electronics? The brains of the system.
That's the second category of losers here, solar inverters and system electronics. We're looking at names like Enphase Energy, ticker ENPH, and SolarEdge Technologies, ticker SEDG.
Now, let me challenge this a bit because Enphase and SolarEdge are often much more tied to residential or commercial projects, right? Putting panels on a house rather than a massive desert farm. Those guys don't have to deal with the same massive interconnection delays as a utility plant.
Technically, you are spot on. A homeowner putting panels on their roof doesn't deal with the same federal permitting queue. However, these stocks are absolutely not immune to what we call sentiment contagion.
Sentiment contagion, meaning investors just get scared of the whole neighborhood.
Basically, yeah. When you see headlines about timeline shock and massive permitting delays, investors tend to de-risk across the entire solar stack. They just assume bookings will slow down everywhere. Plus, there is a very real distribution channel aspect to consider.
You mean the middlemen?
Right. The distributors and the installers. If they sense caution in the broader market, they start buying less inventory. They want to run lean. So even if the residential market is technically okay, the distributor might order fewer inverters from Enphase just to be safe. It creates this overarching atmosphere of caution.
Which brings us directly to the third category of losers residential solar itself. Companies like Sunrun, ticker RUN, and Sonova Energy, ticker NOVA.
Yeah, this is the spillover effect in action. Residential solar is highly sensitive to financing costs and consumer demand. When there are risk-off moves in the broader solar sector, especially triggered by a major player's announcement, these names almost always get dragged down with it.
It seems a bit indiscriminate, honestly. A backlog in the transmission queue out in the desert doesn't physically stop Sunrun from drilling holes in a roof in the suburbs.
It doesn't physically stop them, no. But the downbeat headline widens the perceived risk for the sector. It heavily pressures the multiples investors are willing to pay for future earnings. If the sector just feels weak, these financing-sensitive names take a massive hit to sentiment.
Okay, so that outlines the downside perfectly. The timeline slides, and the solar manufacturers, inverter makers, and residential installers feel the pressure. But let's pivot here. As you said earlier, money doesn't just disappear, it moves. If the solar panels aren't going up as fast, who makes money in the meantime?
That's the crucial pivot. We have to look at the beneficiaries of delay and complexity. The absolute first group is grid equipment and electrification.
Now, this seems a bit counterintuitive. If the generation projects are delayed, why do the grid guys win?
Because the grid itself is the bottleneck. Even if the generation projects the solar farms slow down, the utilities and grid operators absolutely must spend capital on reliability. They have to upgrade distribution systems, install switchgear, and improve the physical connections.
Ah, so the spend shifts from buying panels to fixing the grid.
Exactly. The focus entirely shifts to grid readiness. The infrastructure that actually enables the future build-out has to be built first. We're looking at companies like Eaton, ticker ETN, and Hubbell, ticker HUBB.
These are the guys making the nuts and bolts, or I guess the switches and transformers of the electrical grid.
Correct. Whether that solar farm turns on in 2026 or gets delayed to 2027, the substation needs to be upgraded today. The demand for that specific equipment is robust because it's the prerequisite for everything else.
That makes a lot of sense. Now, let's talk about the power itself. If the new solar plants aren't turning on as scheduled, where does the electricity come from for all these data centers and new loads?
That leads directly to the second winner, dispatchable power. When new solar capacity is delayed, the market is forced to lean on dispatchable supply. That means the existing fleets, nuclear, gas, coal plants that you can just turn on and off on demand.
Because the demand for electricity isn't going down just because some permit for a solar farm got stuck on a bureaucrat's desk.
Precisely. The demand curve is constant or growing. If the new supply is late to the party, the existing supply instantly becomes more valuable. This dynamic heavily supports power pricing and tightens overall capacity.
So who are the names you'd watch here?
You really want to look at owners of scalable generation. Companies like Vistra, ticker VST, and Constellation Energy, ticker CEG.
These are the companies that already have the power plants up and running today.
Yes. And in a world where new capacity is struggling to get online, having an incumbent functioning fleet is a massive asset. They directly benefit from the tightness in the power market.
Okay, there's one more category of winners we need to hit. We talked about hardware and power generation. What about the people actually dealing with the mess on the ground?
The energy transition engineering firms. This is the third category, and it's a great one. We have to remember that permitting delays do not usually eliminate these projects entirely.
Right, they don't just throw the plans in the trash.
No, they complicate them.
And complication sounds very expensive.
Complication is incredibly expensive and it requires highly specialized expertise. When a timeline slides, it often means completely rescoping the project, redoing the engineering schematics, managing highly complex interconnection work, and overseeing a totally disrupted construction schedule.
So the companies that provide those services basically just see their billable hours go through the roof.
In many cases, yes. More complexity means more engineering and construction management. Companies like Quanta Services, ticker PWR, and Fluor, ticker FLR, are deeply embedded in this infrastructure build-out.
So for them, a delay isn't a cancellation at all. It's just a more complicated puzzle that they literally get paid by the hour to solve.
Correct. They are the enablers of the transition. Whether it's building the transmission lines to connect the delayed project or completely redesigning the interconnect to satisfy regulators, they are essential to resolving the exact friction we talked about at the start of the show.
So we have a really clear picture of the landscape now. First, solar's guidance miss shines a light on a major friction point. Solar hardware and residential names take a hit due to timeline shock and sentiment drag. Meanwhile, grid equipment, dispatchable power, and engineering firms benefit from the desperate need for grid readiness and the added complexity of these delays.
That is the trade structure in a nutshell.
Now, for you listening and watching right now, what should you be looking for in the next few trading sessions to actually confirm this trend? What are the tells?
There are three very specific indicators I'd put on your watch list. First, listen for commentary.
Commentary from whom exactly?
From other developers and utilities. Look for follow-through comments on their earnings calls or at conferences regarding interconnection queues and permitting timelines. If First Solar is saying it, are others confirming it? If you hear a major utility CEO complain about permitting delays next week, that is a direct confirmation of the thesis.
Okay, that's one. What is the second indicator?
Watch for revisions. Specifically, you want to look at the 2026 expectations across other solar-adjacent tickers. After this guidepost from First Solar, analysts are going to start sharpening their pencils. They might start downgrading expectations for other hardware players. If you see a trend of downward revisions hitting the wire, the timeline shock is real and it is spreading.
Makes sense. And the third tell?
The rotation signal. This is a pure price action tell. Monitor whether the grid spend names like Eaton, ETN, or Quanta, PWR hold up better than the pure solar names like First Solar or Enphase.
So if the broader market is having a down day, but the grid names are flat or even green, while solar is down heavily.
That indicates a classic rotation. It tells you that the smart money is actively selling the delay and buying the infrastructure. It confirms that the market fully understands the distinction we just spent the last 15 minutes discussing.
It's really about distinguishing between the completely different layers of the energy transition. It is absolutely not just one big green energy bucket that trades together.
No, it's really not. And that brings me to a final thought on complexity for you to think about. When a timeline slides, the knee-jerk retail reaction is often to just dump the stock and exit the sector entirely. But for the sophisticated trader, it might just be a signal to move up the value chain.
How so? Walk us through that.
Well, instead of owning the thing that is being delayed, the panel, you own the company building the infrastructure that absolutely must be there before the panel ever arrives. It's about timing your entry to the bottleneck. The bottleneck right now isn't manufacturing capacity, it's grid readiness.
That is a critical distinction to make. The bottleneck defines where the opportunity is.
It does. The energy transition is happening, but it is not a straight line. It's a series of massive surges followed by frustrating bottlenecks. Recognizing exactly where the friction is allows you to position yourself with the companies that get paid to solve that friction, rather than holding the ones just waiting around for it to clear.
Perfectly said. It's a complex machine, and sometimes the gears grind a little bit, but that grinding noise is music to the ears of the grid equipment makers and the engineers.
Absolutely.
We've covered a lot of ground today, from the specifics of First Solar's guidance to the broader implications for the grid and legacy power sectors. It's a classic example of how a single headline regarding numbers and dates helps reveal the hidden plumbing of the entire industry.
And it serves as a great reminder to always look past the initial headline number and try to understand the mechanical drivers, in this case, permitting and policy, that ultimately dictate the stock prices.
Very true. Before we sign off, I need to remind everyone listening that everything we discussed today is for informational purposes only. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own due diligence.
Thanks for tuning in to Breaking News to Trading Moves. We will catch you on the next one.
Good.